The purpose of this group is to put people in a room together that would normally never be in a room together.
I used to shy away from the property manager. I learned that when you get up to a certain number of units.
Wow, that was a good feeling. So I think that was 2012, 2013.
There are investors who are my clients that haven't even bought it yet.
Well, tonight's guest, Mr. Sterling Chapman, definitely been following you online. So this guy has built a multi-million-dollar portfolio, which is impressive. He's also been putting out some very educational content that I've been keeping an eye on, some acronyms that's in the multifamily space that I never heard of, and you've really been cutting the learning curve on that. And definitely want to give him a warm, big welcome. And I also want to thank you because you inspired me to start wearing thong slippers to closings. I seen you on those pictures. So everybody, please give him a Westbank Real Estate Investors hand clap. Mr. Sterling. Thong slippers. So first of all, this guy comes all the way from Baton Rouge, so thank you for coming for representative of the Red Stick REIA. First of all, we want to start you off with our first question. Sterling, how did you even get started in real estate?
How long you got?
We got a few minutes.
Is there, okay. So thank y'all for having me. So the way that I started with real estate, I never knew about real estate investing growing up, and nobody I knew did it. I always wanted to be like a corporate guy, like you see on TV, like the guy who wears a suit to work every day and travels and moves up and he's a CFO or whatever, some big corporation. And I just thought that was like the coolest thing in the world, and I always romanticized that, and that's what I always wanted to grow up and be. And so I started at a telecom company and started working my way up really fast. And I went back to get my MBA to keep moving up the corporate ladder. And I was taking some entrepreneurship and some leadership classes during that time. And I was like, man, I would really love to like kind of go do my own thing, because in corporate America, specifically in like sales and where the department I was in, you run really, really fast to try and get ahead. And then they're like, oh, he can go fast. And they turn up the treadmill.
Yeah.
And so there's really no ever really getting ahead. It's like if you work your ass off and like kiss ass long enough and give up enough of your life and freedom, they'll promote you to where you can give up more. And so it was just kind of wearing on me. And so in 2017, those entrepreneurship classes got to me. I got a significant raise, and I was all excited to tell my dad how much money I was making. He's like, well, you better go read some, figure out what to do with that money, because I've seen a lot of people make a lot of money and then blow it, and then they look dumb. So I went and read the first personal finance book I could find was Dave Ramsey. And so I read the Total Money Makeover. And I went to she's my wife today. At the time, she was my girlfriend. I was like, look, we're gonna have zero debt. We're never gonna get any credit cards. And she's like, yeah, whatever. And then a week later, I read Rich Dad, Poor Dad. And I was like, scratch that. We're gonna get as much debt as we can. We're gonna borrow all the money. And she was like, yeah, whatever. And so then it talks a lot about real estate in that book, even though it's not really a real estate book. And something else that happened around the same time was my boss. I think my mic's out. Okay. My boss, who had been with the company 15 years and won all these awards and all these accolades, they let him go because they decided to do a little restructuring like they do every year, and they surplused him. Somebody who had never met him, saw his company, his ID code on a spreadsheet out of the corporate headquarters in Dallas. Right. And all of a sudden, after devoting 80 hours in his soul every week for the last 15 years, he didn't have a job. And I just had this vision of like myself, like spending 80 hours a week for 15 years, devoting my soul to this company, and having 2 kids in private school and 2 car notes and a mortgage, and the corporate faucet just getting turned off. And it like terrified me. And I was I was unwilling any longer to like give that much control to like any other person, you know what I mean? And so when the idea of people always like, is real estate investing risky? I'm like, not nearly as risky as only having one source of income, So So I started listening to Bigger Pockets and listening to a bunch of audiobooks. And over that 6-month period, I saved up a down payment for 2 single-family houses. And I bought, it was 15% down, regular, conventional investor.
What year we talking?
This was the summer of 2018.
2018, okay.
And so I bought a house for $72,000. I put whatever 15% plus closing cost is down. I think it was like 14 grand. Fixed it up, and then a month later I bought another one, very similar numbers. And so I looked at the deal, and it was rented out for $1,060, and the note with principal, interest, tax, and insurance was $560.
Good.
So I was like, I'm making $500 a month. And then on the second one, it's like, I'm making $600 a month. Fast forward a bunch of time, and looking back on that, I didn't make that much because there's a lot of other things that I didn't account for, like vacancy and repairs and $8,000 sewer lines and
And
all
what
that.
part of town are we talking?
What do you mean?
What part of the state? Where you did these investments? What city?
One was in Baker,
Okay.
Louisiana. I bought that house for $72,000 in the summer of 2018. Last year I got it reappraised. I didn't do anything to fix it up. Last year I got it reappraised. It was 140.
Good.
And I never ever in a million years thought that area would appraise, but the last few years,
Crazy.
have just been kind of crazy. The other one was in North Sherwood Forest in Baton Rouge.
Okay.
Same numbers, similar rent, same appreciation. But anyway, I was out of money then, and I was getting frustrated because it was going to take me a year to save up another down payment. And I was like, well, there's got to be a better way. So then I started reading on like these creative financing strategies and like these no money down type of guru things you'd hear about on infomercials. And so I found these 2 dilapidated duplexes in a decent part of town. One had flooded, one had just been trashed by a tenant. They were owned by the same person, and I got them under contract for $190,000. And I had no idea how I was going to buy those. And I had no money, and I had no experience. I couldn't hang a doorknob. And I went to a friend of mine that I knew that flipped houses. And I was like, how do you buy these houses to flip? And he's like, well, I have investors pay for it. And I was like, well, how do I get investors? He goes, well, you have experience doing it, and they'll invest with you if you have experience. I was like, well, I don't have any of those, so I'll make you a deal. I was like, I'll give you these 2 duplexes I got under contract. Use your investors, use your experience. When we buy them, just add me to the title, and then after you're done rehabbing them, I'll go to the bank and I'll do a cash out refinance. I'll pay your investors back, I'll pay their interest back, and I'll give you a check for $50,000. And he was like, okay.
Are you still working at this time? Full time?
Yeah.
Okay.
Yeah. And I was traveling a lot too. I mean, at the time, I was traveling all over the U.S. I mean, 3 weeks out of every month, I was in another state. And half the time he was working on them, I was in another state. And so I didn't sleep for 6 months, and it all worked out. And so his investors actually didn't have enough capital to cover the purchase and the rehab. So I talked my brother into putting some money he had in a HELOC in. So they're like, there's all this risk. I knew his investors. I had my brother's money. I owed him money. And like, I had no idea like how things appraised or how to fix things up. And like, I didn't sleep for 6 months, but it all worked out. Like they appraised for $390,000 after we fixed them up. I went to the bank and they wrote me a check for 80% for the mortgage, and that was $312,000, which allowed me to pay back the investors, pay back their interest, cover the $60,000 rehab, and pay him $50,000, and walk away with $2,000 a month in cash flow and $78,000 in equity. And that move right there quadrupled my net worth in 3 months. You know what I mean?
So what happens next? So now you have this nest egg. You still got the corporate handcuffs on at this time. You're getting your first taste of raising capital. What's your mindset at work when you're going to work now? You're traveling.
Initially, I worked harder because I wanted to get more capital to invest more. And as I was traveling, this weird thing happened to me because I would fly. I live in Baton Rouge, which is a good hour drive from the New Orleans airport. And I would fly out on, and my wife was pregnant with our first son at this time, and she was on bed rest the whole time. Had to get rushed to the hospital multiple times when I was out of town traveling for work. And all my life, this was what I wanted. I wanted this like big fancy corporate regional director job where I was going to travel all over in suits and everything. I thought that was cool. And I'd fly out like on a Tuesday morning, and then I'd fly back in on like a Thursday evening. And sometimes I would land, a lot of times I would land in New Orleans at 11 p.m. and then get in my car and drive home for midnight. So I was flying back from like DC or something, and I was in this suit that I'd been in since probably 4 a.m. It was this wrinkled suit. My feet hurt from these, like being on the airplane in these little like dress shoes. And I saw this guy, and I was just tired, and I was miserable, and I just wanted to be in my bed, and I was just exhausted because I'd been doing it for like 6 straight months. And I saw this guy that was like 3 rows ahead of me, and he was like in his mid-50s, and I could tell he was in the exact same situation that I was in. And that is who I wanted to be my entire life. And at that second, I realized, what a chump. That is not who I want to be in 30 years. I want to be sitting on the beach in 30 years, you know what I mean? So, after that, I kind of scaled back my responsibilities and started working towards building the portfolio and the passive income and the business. And so I went out and I got a lot of properties with seller financing. I got a lot of duplexes and a lot of fourplexes with seller financing, with some partnership agreements. And then I started burring houses. And so I'd borrow capital or, get investor capital, go buy the property cash, fix it up, and then go to the bank and refinance just like I did with the duplexes. But I do it over and over and over again, and built up a rental property portfolio of a little over 70 units.
I want to slow you down a little bit. So it sounds like you're ramping up as far as acquisition, right? But you're still working that corporate job. So for the person that's still working and they want to ramp up, what did lead generation look like for you to speed that process up?
What do you mean?
So far as maybe those first properties, how did you find those first 2 that you bought? Those were on the market or?
No. I barely ever buy anything on the market. So I've used almost exclusively wholesalers throughout my entire, there's a handful of properties that I either saw on the MLS and made a lowball offer, not usually very successfully. I could probably count on one hand how many houses I bought that way. My realtor that sells my flips, he's a buddy of mine. He's brought me less than a handful, but all of the other ones came from from wholesalers that I met in rooms exactly like this.
So at the job, wholesalers are bringing you these deals to get you out of this.
And to be perfectly transparent, I still have a job. So I don't spend a lot of time doing it because I manage a sales team. They do the work, and I just kind of do some pep rallies from the house on Zoom meetings.
Wolf on Wall Street.
Unless my boss is watching this, in which case I work all the time. But don't be in too big. If you got a good paying job, if I would have had one of those 40-hour-a-week got to clock in jobs and can't go anywhere, I would have quit 3 years ago. But I'm not, because of all the work I did on the front end of that. I've been in a very, very flexible situation.
Yeah.
And I see a lot of people that are in such a big hurry to go and quit their job. If you've got a history of a very stable W-2 income, there is nothing the banks love more. So I have never struggled to get a loan ever. And my lenders all tell me the second you quit that job, it's going to be more of a pain in the ass to get loans. So they're always trying to talk me into staying, but I'm not gonna. But I've never gone out there. I've never been direct to seller. I've never done any bandit signs or knocked on any doors. I've just come to meetings like this, built relationships with wholesalers, and not tried to nickel and dime them. I underwrite the deals to see if they work for me, and if what they're offering works for me, I hope they made 20 grand. I hope they made a lot. Not the last one, but one of the last houses I bought wholesaler made 55 grand off of me. And I was like, hell yeah, dude, go get me another one. Because it worked for me, you know? I'll make 100 grand off of that deal. So I've always been very intentional about nurturing those relationships and adding value to them wherever I can and staying and really building up. So I've got an army of wholesalers that go out and find properties for me.
And I'm glad you said that. So for the person that's either trying to get their first deal or trying to get their 100th deal, what does it look like to network with wholesalers or people to bring you deals? So if they're in a room today, what kind of should be or could be their approach to start building those relationships and to get them to send them more deals?
I mean, you build the relationships like any other relationship you build. You don't come to a meeting and hand out as many business cards as you can and then collect as many business cards as you can. I've done that a bunch of times, and all those business cards always stayed in the drawer, and I never talked to those people again. And that's not, you know what I mean, a way to build a relationship. The way to build a relationship is most wholesalers are pretty eager to put as many cash buyers as they can on their list, right? So they'll add you to their list. From there, you just engage with them. If they send you a deal, you give them feedback. You say, well, look, this doesn't really meet my criteria. What I'm actually looking for is, 3 2s in these zip codes that have like an ARV between 175 and 400. And I really like stuff that, that's not in a flood zone. And so that way they don't send you a bunch of garbage. It's like, and I say garbage, like everybody makes money in every area. It's just different, whatever type of asset class you want to go after. So if they don't know what you're going after, then they're going to send you those low-income properties, and you don't buy that, Or if you're all into low-income properties, and they're sending you $500,000 flips, and you're like, well, I'm not into that. So give them feedback about what you're into and engage with them, you know what I mean? Acknowledge that they're sending it to you and follow up with them and call them and ask them how they're doing and ask them if there's anything you can do to help them. I've wrote many of checks to wholesalers. I'm like, how much marketing are you doing? Like, well, I'm only doing like $500 a month in marketing because I don't really have the money right now. I'm like, cool. Would $1,000 help you get some more marketing out? And they're like, yeah. Here's $1,000. The next time you come across something, think about me. So I've done that a lot of times, and I've coached a lot of the wholesalers because there's like a continuum with wholesalers, right? I usually never get more than about 3 or 4 deals out of a wholesaler before they start doing them themselves. Because a lot of times they'll come and they're like, I want to get into real estate investing. I don't have any like assets, or I don't have any income. So what's the first thing you can do? Oh, well, you can go wholesale. There's like 0 barrier of entry. You can watch a YouTube video and go wholesale, and you can like build up some asset, some assignment fees, and you can take that money and then you can go like buy you rental properties or fund your own flip. Once they do that a handful of times, if they have somebody that's willing to help them and kind of show them, like they realize like they can actually do the deal themselves. There's actually lenders out, like asset-based lenders out there that will really fund anybody, and they'll fund 90% of the purchase price and 100% of the rehab cost. And they look at the debt service coverage ratio of the asset or the value of the asset. They don't care about your W-2. They don't care about your debt to income. And so like once they start seeing that, they start flipping their own houses. They start holding their own rentals. So they kind of graduate up the continuum. Some of them continue, right? Like some people build out a strong like acquisition infrastructure. I just never did. I focused on building out a capital raising infrastructure. I never built out an acquisition infrastructure for single families. But a lot of people build it out and they'll pour money into marketing, and even once they start keeping them, they can't keep them all, so they'll wholesale them. So I got buddies of mine that flip houses, that have a bunch of rental properties, that they do a lot of marketing, and they're like, look, Sterling, I'm doing 6 houses right now, but I had a good one across my desk. I'm on the other side of that, I'm doing 6 houses right now, and I had a good one across my desk this morning.
Without
and I
paying
called
for the marketing.
I called my buddy and I was like, dude, I can't really do any more this week.
Yeah.
Like, you want this? I didn't charge him for it, but I mean, regardless, when you're new and it seems like people are like doing so much, you kind of like get this like, oh, well, they're going to do all the good ones type. This really limited mentality. It's like, like whatever the opposite of an abundance mentality is,
Yeah.
like, you know what I mean? And they're like, oh, well, Sterling's doing all the good deals. Like, nobody can buy them all. You know what I mean? Nobody can buy them. Like that's just not how it is. There's enough out there for everybody.
I agree. So take us back to 2018. I'm glad you went a little bit deeper. So networking with those wholesalers and building relationships with more wholesalers helped you ramp up a little bit faster. So what was next after that? So you start seeing yourself building momentum. What was next?
By the end of 2019, I had 26 rental properties that I was self-managing. I had a newborn baby, and at the time I still had kind of demanding corporate gig going on, and I was managing properties, and I thought I wanted to be a property manager when I started, but I quickly realized I didn't. It was terrible. I was like, I mean, you're dealing with people lying to you, people are trying to steal from you, you're fixing shit, you're picking up trash out of the neighbor's yard. I'm like, dude, I'd rather go sell internet. Like, you know what I mean? What am I doing with my life? So I was like, there's got to be a better way to scale out of this. And so I read a book by Joe Fairless called The Best Ever Apartment Syndication Book. And he talks about all the benefits of large multifamily properties and all of the efficiencies with large multifamily properties versus, single families that are all spread out. And so once you're sold on the concept of how large multifamily properties cash flow a lot better, a lot more recession resistant, have a lot more operational efficiency when it comes to management. Once you're sold on the concept, you're like, well, that's great, but how do I go buy a $5 million apartment complex? Well, you raise capital to do it. And well, how do I get people to give me millions of dollars? Well, step one is you become a thought leader in the industry. And so you do things like start meetups like this. I started my podcast, the Rent Roll Radio Show. And outside of Robert Kiyosaki and Grant Cardone, I have interviewed every single person that I ever looked up to. I mean, I've interviewed every single person from Bigger Pockets. I just interviewed Brandon Turner, Rod Cleave, I interviewed Joe Fairless, the guy who wrote the book that got me started. So it's been a great networking opportunity to build my network through interviewing the guests, and it's given me a tremendous amount of credibility with potential investors. So the thought leadership platform, the Meetup, those, and then the social media, sharing everything on social media. I do a lot of social media stuff, and sometimes my friends give me a hard time, and they're like, oh, you're always bragging about how much money you're making on social. I'm like, dude, I don't give a shit if anybody knows how much money I'm making. I'm marketing on social media. I'm trying to bat signal to the potential investors, to the wholesalers. Now, the reason wholesalers line up to me is because they see me closing deals every single week, and they're like, oh, well, if I want I want their deal to close, right? Because a lot of people BS them and yeah, I can get the money to go there and close. So when I show up and close on time, quickly, every time, that's what they want. They don't want any hassle. So when they see me doing it over and over again, it's ingrained in their mind, and I'm always top of mind because I'm always in their face closing deals. So when they get one and they're like, oh man, there's a good, I know Sterling can close, I know he can close quick, and I know he doesn't nickel and dime me. Right. So I'm just their first call before they go through all the rigmarole with a bunch of people, because dude, that's a hassle for them. If it gets locked up, and it gets locked up for a month, and then the person can't close, and then they lose the contract, and they lose their deposit, and they didn't get their assignment fee, that's no bueno.
I've been there, man. So I know exactly. And David Birdsong can attest to that. So I definitely agree with you. Now, before we get into raising capital for the $5 million deals, for the person that wants the single-family portfolio or wants the 1 to 4 unit portfolio, what did fundraising look like for those smaller property classes compared to now? Was it easier to raise money for a $160,000 deal, $30,000 purchase, $90,000 rehab? In 2019, what did fundraising look like for those property types?
So it wasn't, I don't know if it was easier. It was different. It's still a different conversation. I've always been very generous with my returns to people. And I do that for flexibility and for volume. So, you know, I did in the beginning of 2019, I did that duplex deal. And so that gave me a little bit of credibility. And then throughout 2019, I did a lot of the seller financing deals. And then when I really started BRRRRing properties, when I really started like saying, hey, give me $100,000 and I'll give you 120 grand back at the end of the year, that was at the beginning of 2020. And I did just that. I went to people and I was like, hey, like, and at that point I had, you know, 26 properties. So like, well, he must know a little bit about what he's doing. But I would just tell people, hey man, give me 100 grand and I'll give you 120 grand back at the end of the year. Like promissory note guaranteed. Like even if my deal goes south, like I'll give you the 120 grand. And you know, if you're promising people 20%, like they'll line up out the door for that.
Yeah.
Like people don't understand like how impactful 20% gains are, right? Especially for the guy that's not an active real estate investor, for the guy that's been getting 6% in his 401k, or the guy who's, you know what I mean, doesn't have the time to do what we're doing. People get distracted with this like lottery style investing, Bitcoin billionaire stuff where like, I'm gonna strike gold. Dude, if you put $100,000 into an investment vehicle that gives you 20% a year, after 5 years, you've doubled your money. You have 200 grand. If you double that money again, after 10 years, you have 400 grand. After 15 years, you have 800 grand. And at 20 years, you have $1.6 million. So you've turned that 100 grand into $1.6 million. You 16x'd your money over a 20-year period. Now that's incredibly impactful. You know what I mean? If you've got somebody that's got a good job, a doctor or whatever, and they got their little, you know, their pension for retirement or they're contributing to their 401k, and you can do that on the side, you pretty much just doubled the quality of their retirement. You know what I mean? Like that is 20% return is very impactful, and so when people line up for that all day long.
And speaking of lining up, I'm glad you said that. How do I even start? First of all, who do I target? How do I learn who to target to even begin to have that conversation to tell somebody, you know, you give me 100,000, I give you 120,000 back. What has been your experience with finding the correct people to even have that conversation with, especially in the beginning? Was it uncomfortable, or what was that experience like?
No, it wasn't uncomfortable because I never asked anybody for money. I was simply very public about what I was doing, and everybody wants to do it, right? I mean, it's not like a niche deal. Like everybody's like, oh yeah, you can make a ton of money in real estate. I'd love to make a ton of money in real estate. But nobody has the time or the energy or the wherewithal to actually like do all of the work and take the risk and all that stuff. So, but if you're public about what you do and everybody knows what you do, typically they'll say, how can I get involved? And I just give them their options at that point. I'm like, well, you could do this, this, and this, and dedicate, you know, all day, every day, and your weekends and your nights, and try this and take this risk. Or you could just give me 100 grand and I'll give you 120 at the end of the year. You know, and they're like, yeah, that sounds like a better option. I'm gonna go to the football game. Here you go.
Yeah.
You know what I mean?
And have you found a balance as far as being public, walking that tightrope of being informative and being annoying? You found that balance yet?
I guess that depends on who you would ask.
Yeah.
So, you know, the annoying part is an insecurity, right?
Yeah.
I guess, who am I annoying? You can always unfollow me.
Yeah.
I don't corner people at parties and like real estate. People corner me at parties and go, hey, tell me about real estate. But I mean, as far as what I'm sharing on my social media field, I didn't for a long time because I was insecure about being annoying. But the more and more I broke through that insecurity and just started sharing, the more and more people came out of the woodworks, man. Every time I share something, I get DMs. I want to get involved. I want to invest in your next deal. Hey, you know, when's the next meetup? Like, I've never gotten any pushback, you know, about being annoying. You know what I mean? Like, I don't corner people at parties and try and shove real estate down their throat. Most of the time when I'm in large groups, people are cornering me trying to get more info on the real estate.
Yeah, and I share that because there are people in the room that are doing what you're doing, and then there's other people in the room, confessions like me, that are hesitant to do it because, just like you said, some of your friends might say, why you keep posting that? I guess it is insecurity, but it makes your career more fruitful to be public about exactly what it is you do.
I mean, it just goes back to like, why are you posting it, right? I don't give a shit, like, if people know how much I make, right? So I'm not posting it for that. I'm posting it for marketing. And marketing, obviously, we know works the more times they see. I mean, drive down I-10, right? Like, how many Morris Bart, billboards you see? You think he gets less phone calls because he's got 50 billboards? No, I mean, I try and I guess if I just added, I guess if the content sucked, it would be annoying. If I was just saying like some stupid shit, it would look annoying. Yeah. But like what I try and do is create valuable content. Like I'll post a picture when I go to a closing, and I'll run down like the numbers of the deal, not because I want to brag about it, but because I want to inspire people. Like, hey, this is what you can do if you're doing that. Or if you don't feel like doing it, you can always still benefit from some of this because I paid my investors. You know what I mean? And so, it also gives me credibility. Like, you should probably listen to me because look, I'm buying all these houses. I know what I'm doing. And then the reels, the shorts that I've just started doing recently. I mean, I don't ever put anything out that I don't feel like is like educational, good content. I mean, I've never gotten any pushback from it. And I think that am I annoying people is like, I mean, that's just the insecurity, or you're not putting out good stuff.
I think that's excellent advice. So let's fast forward to the syndication piece. So 2019, you knocking it out the park, 26 properties. How did you scale out of that to get to the freedom part? Because you were self-managing, and you saw that wasn't the way. How did you get out of that? And then how did you get into the apartment game?
So it's such a long, blurry story. In early 2020, I had a fourplex, and I had a tenant move out, and I put a new tenant in, and she was a nightmare. I called her Devil Woman. I should have known. It should have been a red flag. She paid 3 months cash up front at closing, and she immediately, right after she signed the lease, she turned on me. And the lady below her called me the next morning. Total coincidence. This was some older properties I had over by LSU, and this was when I was managing. And I don't know what I'm doing from a management standpoint. I don't know how to fix anything, But one of the hot water heaters upstairs was rusted out, and it was leaking on the tenant below. So water was leaking in her kitchen, and she called me 7 in the morning. I was like, "There's water leaking in my kitchen." I'm like, "Oh shit!" So I run over there. She's like, "Look, it's coming out of the ceiling." I'm like, "Okay, well, I guess I'll go knock on the upstairs and ask them what the deal is." And so I go knock on it, and she wouldn't let me in. And it turned into this really, really confrontational deal over the next 4 days, where she wouldn't let me in. She was cussing me out. She was telling me to get the F out of her property and a lot of other things that I'm not going to repeat on Facebook Live. And basically hey, it's COVID. You can't evict me. You can't do nothing. This is my house now. And my property was getting damaged, and my other tenants were about to move out. And finally, I had to get on my hands and knees and grovel with this lady to get her to allow me to go in and replace her hot water heater. I was trying to fix her hot water heater. And so we did. And then, anyway, after it was all said and done, I'm laying in bed with my wife at 9 o'clock at night. And I get a call from her. And she was like, "Hey, my hot water doesn't work." And she's like, "I turn it on and it just blows air." And I knew that she just had to leave it running for a minute because we replaced it. We drained the lines to replace it.
You talking about the problem tenant or the tenant below?
The problem tenant.
Okay.
The bitch called me. and so I was like, "Yeah, I'll send a plumber tomorrow." And she was like, "You're not gonna send somebody tonight?" And I was like, "Nah." And she was like, "When that lady called downstairs, you ran over?" I was like, "That was at 7 in the morning. Normal people wake up in the morning and go to bed at night. It's night. I'm going to bed." Right. And she's like, "Okay, I'm going to show you." And she hung up, and about 30 seconds later, I get a call from the lady downstairs, freaking out, yelling at me in Spanish. And I was like, I don't know what you're saying, but she's like, so she sent me like a FaceTime of water being poured in from above, because we had, where the water was leaking, we had cut out the sheetrock, and then we had gone in and replaced the hot water heater, and we were going to go patch it the next day. So for that night, there was a hole between the two, and so she thought she was pouring water down on the tenant below. And I jumped out of bed, and I was getting dressed, and I was like, I'm going to go over there. And my wife's like, don't go over there, you're going to get shot. And I was like, you're right, I should get my gun. She's like, don't bring your gun, you're going to shoot her. And I was like, God, no. I was so mad. I called my buddy the next morning that managed a bunch of properties at like 5 a.m. I was like, dude, if you don't take them, I'm going to give them to somebody else. And he's like, I'll take care of them. So he managed them. And I always say that if I wouldn't have given up the management that day, I would still have 26 properties. Or 0, you know what I mean? But I certainly wouldn't have scaled to, all that I have now, because it just freed up. A lot of people want to go do the work themselves, or they want to do the management themselves. And if your intention is to grow into this owner investor, you don't need to go get a job. You don't need, if you're trying to get to a $1,000 an hour spot, you don't need to be doing $20 an hour stuff. I was out there picking up trash in the neighbor's yard so that when my, so that when my tenant showed up, like, they wouldn't think the area was bad. Right. And then the potential tenant would like ghost me anyway. They would like stand me up. And so it was just, once I freed that space up, it allowed me to build up a huge single family portfolio of BRRRRs over the course of the next couple of years. It freed me up to network and build into the apartment syndication space. It took a while to get going in apartments because it was a very competitive time.
Let's talk about that. So now so all 26 you dumped on the property manager?
I had him manage them. I still own them.
Right.
Yeah.
No, that's what I mean. So you scaled out of managing by giving that portfolio to a manager. Okay, yeah. So now what's next? So you cut the cord, and what happened to the tenant too? The tenant, the bad one upstairs.
She ended up moving out several months later.
Yeah.
I forget what. She stayed there for a while. Every once in a while, my buddy will still call me and be like, "Hey, you remember Devil Woman?" I was like, "Oh, I remember."
Not your problem.
I remember.
Yeah. So what's next? So 26 properties. We got a property manager now.
So I kept buying them, man. I was burning houses, and I was looking for apartment complex. Did I break it?
I don't think so.
So I just kept buying houses and burning them and looking for apartments. We closed on our first apartment syndication in February of 2021. So it took every bit of a year and a half to get that done. The whole time though I was buying, I think we BRRRR'd 4 houses in 2020, and then I bought some more.
Move closer again.
I bought some more through seller financing, so I bought a bunch of units, but I did 4 rehabs. With that investor capital I took on at the beginning of 2020, I took on $200,000, and I told each of them, I said, I'll give you $120 back at the end of the year. So I took that $200,000 and I BRRRR'd 4 houses, and in the BRRRRing of the 4 houses, I created $270,000 in equity. So at the end of the year, when I had to pay the $40,000 in interest, I was still $230,000 ahead. So in 2021, I did about 18 of them. And then in 2022, I think we've bought 18 houses so far. We did our 54-unit apartment complex at the beginning of 2021. We did a 70-unit apartment complex at the beginning of 2022. On Monday, I'm partnering with a group that's doing a 350-unit apartment complex in Houston, and then we have a 45-unit that we're closing on in Norfolk, Virginia.
Awesome, man. Tell us a story about the 54 unit.
So, apartment investing, large multifamily is a team sport. A lot of it, you know what I mean? A lot of the single family stuff you can kind of do by yourself, but when you're trying to raise millions of dollars and, find properties that work and underwrite them and asset manage them, you really need, like, it's really not the best idea to go in just by yourself. So you see a lot of like teams that do it. So when I first started, I teamed up with this guy because I didn't have time to underwrite or to do the acquisitions. Because I can underwrite a single family house like in my mind. Like I can just look at it and go 70% cash flow. Okay, good. You know, you can't do that with a 100-unit apartment complex. There's too many moving parts and levers, and so you really need like it's a several-hour process to sit down and go through and underwrite and create a business plan for that. So I partnered with one guy that was supposed to do the acquisitions while I focused on the capital raising, and we weren't able to lock anything up for a year. And then finally he introduced us to another group that had the Georgia deal under contract, and that other group, they're my partners on every deal. But they found it cold calling, just like wholesalers find distressed houses. They hired virtual assistants from the Philippines to cold call real like apartment owners, and they came across this apartment complex that the people wanted out of, and so we went and raised $2 million, and we paid $4.2 million for it, and we put $800,000 into renovating it, and now it's worth $9 million. So
Perfect. So let's break this part a little bit. So it sounds like, as far as lead generation, finding an apartment deal is very similar to finding a single family.
It can be. Mm-hmm. The other way that a lot of people do it, though, is through broker relationships. So our 70 unit in Rock Hill, South Carolina, that was done through a broker relationship. And then the 45 unit we're working on was just like a referral from somebody else we had worked with before, knew we could close, and reached out and told us about it.
So at the end of the day, relationships is still prevalent in your systems. Tell us about why it takes so much time on the underwriting side for an apartment, and why a designated person is important to be taking lead on that versus underwriting just a single family property. Where does all that time go, and why?
Yeah, so first of all, there's a lot of market research that goes into it. So typically when we buy, like I always say, like I can buy a $300,000 house in my backyard, but my backyard's really not the best place to be buying property. Like from a macroeconomic level, right? Like your backyard isn't either. Like when you look, now people can make money in any market, but when you look at like what makes a great market that is really poised for long-term growth, you look at the key economic indicators. You look at like population trend. So are people moving there, or are they moving away? And you want obviously to buy. I mean, your whole goal here is to raise the rent. So you need an area where there's going to be high rental demand. So you're going to need people to live there. So you look at the lead indicators, the population trend. And I don't know if anybody's checked the population trend lately, but people are moving away from Louisiana. They're moving to Texas and Florida and Georgia. And
what do we find there? What database would tell us that the population trend is going up or down?
You can Google that.
Okay.
It's Census Bureau information. You can Google it. You can go to realcitydata.com, and it'll tell you. The next thing we look at is job growth. So are they adding jobs? Because people move where there's jobs, Are they adding jobs? If they're adding jobs, like what kind of jobs are they adding? Like what's the, how much are they paying? And then job diversity is a big thing, right? So you don't want to be very vulnerable by like one specific company or industry. So like picture buying a multi-million-dollar asset in Detroit right before the auto industry goes overseas, and now everything in Detroit went, now it's all of a sudden worth a 20th of what it was before. So I feel that way about a lot of South Louisiana because of the oil industry. You know what I mean? Like that's a huge vulnerability. So that's why we buy large assets in areas where there's a lot of diversification, like we got a deal right outside of Atlanta, Georgia. Like there's all these different companies in these different industries headquartered in Atlanta, Georgia. Like no one industry or no one company's bankruptcy is really going to upset the local economy in Atlanta, Georgia. Same thing with Charlotte, North Carolina, Norfolk, Virginia. You know what I mean? There's a port there. They're always going to need a port. There's a lot of government, you know what I'm saying, military stuff there. That's recession resistant. So the local economy is gonna thrive regardless of kind of what goes on in the macro environment. We also look at like supply and demand. How many permits have been pulled for new construction in the area? Like how many more units, how much competition is coming online? You know what I mean? Because like you might buy in an area where there's very low vacancy because there's a huge demand, people are living there, and there's barely any inventory. But if they build 1 million apartment units the next year, well, now all of a sudden you've overbuilt and you got a supply and demand issue. So we monitor that as well. And then crime and poverty, and people want to, you know what I'm saying, move where there's low crime and poverty.
And your team lead on the front end, your acquisition person, all this stuff is coming from Google or the site that you mentioned, or the other databases where we can find this to put together a marketing packet for you to go out and start pitching investors? Where all this data coming from?
We actually, what I use, there is a guy I've interviewed on my show twice. His name is Neil Bawa. He is they call him the multifamily mad scientist. So he was a data scientist before, and he focused his investment strategy is around buying in areas where people are going to move. And he put together this spreadsheet that has like these 10 indicators that like determine whether a market's poised for growth. And inside there, he put the links to the different websites where you can source that information. So I've got that saved to my desktop, and I use that to underwrite markets. And then also that book I mentioned by Joe Fairless, he details how exactly he underwrites the markets in a very similar fashion. So it's relatively easy to put that information together. But when you're underwriting, to go back to your original question, when you're underwriting large multifamily properties, you've got to look at, you know, what the rent comps in the area are. You got to, because when we're investing, right, we're not gambling, we're not speculating, we're not like buying an area and like hoping it goes up. When I buy a single family house or an apartment complex, I know the true value of it before I buy it, right? I don't just buy it and go, I hope I get a lot of money for this when I fix it up. Like, if I buy, the first thing I do when I see a potential house or apartment complex is I go, all right, what's the true value of it? What's the value going to be once, you know, the renovation is complete, once the value add strategy has been executed? And I know that going into the project. So there's no like, I'm gonna buy Bitcoin and hope it goes up. It's like, I know what it's worth, and I'm buying it at a discount. That's where, because every time I come to these meetings and I talk to a bunch of people, I'm like, yeah, sure, I'd love to, you know, look over your deal. Like, I'm happy to help in any way. They always start sending me deals off the MLS. And I'm like, you're probably not going to find a good deal in the MLS because it's publicly marketed. The market is efficient, and that'll drive it up to equilibrium price. And you don't want to buy something at the market value. You want to buy something below the market value. Like, that is our charge as investors. That is how we build profitable businesses, is we buy below the market value. So, you know, I'll get a house, and I'll either look on Zillow or PropStream or send it to my realtor and go, how much is this house worth fixed up? And they'll pull the comps, and they'll go, well, based off of all the other houses at that square footage in that neighborhood, if you update that house, it will sell for $150 grand. And I'm like, cool, well, I can get it for 50, and I know it'll cost 50 to fix up. So if I know before I buy it that it'll sell for 150, and I know I can get it for 50, and I know it'll only cost 50 to fix up, I already know going into that project there's a 50 grand profit. Same thing with apartment complexes. You value them a little different. So like a single family house is valued off of the comps in the neighborhood. An apartment complex is a business. It's valued off of the cash flows. It's valued off of the net operating income. So all apartment complexes trade at a capitalization rate or a cap rate. So, you know, an average cap rate that they'll trade at is 0.05. And it's kind of getting in the nitty-gritty go into the details of it, but what it really is, it's the unlevered return. Basically, if I bought it with cash, what percentage would it kick off every year, right? And that's usually around 5%. So the way we increase, the way we determine the value of an apartment complex is we take the net operating income, which is the revenue minus the expenses, and we divide it by the capitalization rate, right? So the way we increase the value of an apartment complex is we raise the rent or lower the expenses, and we increase the net operating income. So the example I always use for the apartment complexes and what I do to kind of, this is a very, very high level explanation of what I do with apartment complexes. So picture we're going to buy a 50-unit apartment complex, and you give me $1 million to go buy this $4 million 50-unit apartment complex, right? So I take your $1 million, I go to the bank and I get $3 million, and now I got $4 million, and I buy this 50-unit apartment complex, right? Then I raise the rent on every unit by $100 a month, okay? So now I've increased the rent by $100 per unit per month, which is $5,000 for the whole property, right? Because 50 units times $100 is $5,000 a month. Times 12 months is $60,000. So now I've raised the revenue. I haven't done anything to the expenses, but I've raised the revenue by $60,000 a year. So I've increased the net operating income by $60,000 a year. You follow? Now you divide that $60,000 by the cap rate, by the capitalization rate. So if you divide $60,000 by 0.05, you get $1.2 million. So I just added $1.2 million to the value of this apartment complex. So now this apartment complex that I bought for $4 million with your $1 million and the bank's $3 million, it's now worth $5.2 million. So now I can go sell the apartment complex for $5.2 million. I pay the bank their $3 million back. I give you your $1 million back. I give you another $1 million, and then I take the other 200 grand and stick it in my pocket. Make sense?
Good example.
So that's what apartment syndication is.
Yeah. So tell us about building that team. So you said apartments is a team sport. You got your acquisitions guy. If I'm just coming from the single family world or the 1 to 4 unit world, how do I even find or partner up with somebody that can run those pro formas and run all of that data research so we can go out and raise capital and pocket all this money?
Man, there is a lot of educational stuff out there. And I used to be really against, and I don't sell any, by the way, but I used to be really against all the gurus and the sales coaching and all that kind of stuff. But after interviewing 150 investors on the podcast, a lot of them really, really successful. I mean, billions of dollars in assets. I found that all of the really successful ones, they like paid for coaching. They went out and paid a mentor, like some of them like $50,000 to like teach them everything they know and hold their hand through the beginning of the process. I never paid for coaching. I probably would have gotten where I am faster had I paid for coaching in 2019, but I didn't have 50 grand lying around in 2019. You know what I mean? I just didn't have it. You know, and now I know enough that I don't need to pay for the coaching, but a lot of people go the paid route. What I did was I started a podcast and interviewed a bunch of people and built my relationships and my network that way. I've been to a lot of conferences all over the country where all of these multifamily investors congregate, and I've gotten to know them that way. Very much like coming to these events, except for, you know, you pay $1,000 and fly to Denver or Charlotte or Atlanta or wherever they're having them, and, you know, connect with people there. But, I mean, that's how you do it.
So that team member, you saying you meet team members like that at those events, or you take those systems
So
and
I can tell
train
you,
a team member?
I can tell you exactly how my team, my core, what I call it us core four, how that evolved.
Let's do it.
So I met the one guy that's not really involved in the core four anymore. I met him on Facebook. He posted in Bigger Pockets, like Bigger Pockets Facebook group, that he was looking for capital raisers for his syndication group. And that was right after I read that book and started the podcast, and I was like, I could raise money. At the time, I had more people wanting to invest with me than I could find deals for. I was like, I can raise capital, but like I don't have the time to sit there and underwrite these apartment complexes or build these relationships with these brokers in other states. So I called him and I was like, hey, I'd be interested in raising capital for your group. I went to the first meeting and they were on this model where they kind of like give the investors very little return and they take the bulk of it, which is fine, but that's not really what I wanted to do. I wanted to build this like really big long-term business based off of like repeat investors. So I wanted to give more of it to the investor just to build this really big thing over long term. I wasn't trying to get rich off my first deal. I was just happy to be involved. So I was like, that's not really what I'm interested in. Like my investors are going to want 20%. You're talking about giving them, 10. So I said, I'm not going to work with y'all. And then the guy that I initially reached out on Facebook, he called me, he goes, hey, look, I agree with you. Let's go find something together. And he was a commercial banker. He underwrote apartment complexes and businesses for the bank. So he knew how to do the underwriting. But he wasn't as social as me. So we tried to do it. He just wasn't able to, get any projects under contract. And it was a hard time during COVID and during the printing all the money. There was just massive amounts of liquidity, massive amounts of competition in the market. It was a hard time to because everything was just going up and there was so much competition at the time. And finally, he ended up meeting Chris and Parker, who are Clear Bay Capital, who are my partners now, and they had the Georgia deal under contract, but they weren't confident in their ability to raise the funds to close it. They just got it under contract because they were great at underwriting and they were great at acquisitions. And so my other partner, he introduced me to him. He's like, well, Sterling can help y'all raise capital. So we all worked together on that project. And we also, there was another guy, Brendan, who had met one of the guys, Chris, at a local RIA just like this. And he wanted to get involved. So we let him in, and then on the next deal, it was those two guys from Clear Bay and me and Brendan. And as it turns out, because of Chris's corporate background in private equity, he was excellent at underwriting. And I mean, he's just an Excel wizard, and he knew what to look for. And so him and his partner handled the underwriting and the acquisition side. I was just naturally gifted at raising capital, so I focused more on the capital raising. And then our other partner, Brendan, he's just really organized and great at, he wasn't a big, huge fan of underwriting, and he just didn't, he wasn't that great at raising capital, but he was really organized, and he did a great job managing the property managers and the lender and the construction worker. So he just kind of fell into the asset management seat. And now on this new project, we're just doing, every project we work together on, we lean further into our core competencies. And by tripling down on what we're good at, we get way further than if we were each trying to carry all the plates. Because if you try and do everything, you're not doing anything really good.
Good point. So that breaks down acquisitions, and thank you for that. So what's even more important, tell us about operations. So you said you got a guy that's an asset manager. He looks over the property managers. What does that life really look like? Let's use the 50-unit example. Sure. After closing, what does it look like now? So with the 26 units, you had one devil, so now you potentially got 50 devils. Yeah. And how do you manage that being out of state?
Yeah, so it's a lot easier than the 26 were. There's a lot of benefits of all the units being exactly the same, having the exact same paint color in every unit, the exact same flooring, the exact same sinks, you know what I mean, one location. So there's a lot of efficient operational and management efficiencies that happen there. And so another thing is that the property managers that manage large apartment complexes are way more professional than the property managers that will manage a single family portfolio. So they had like in-house construction. So they had they have a construction manager, like a VP of construction management, who actually goes and oversees the contractors and makes sure they're doing everything and collects bids from them and helps us get the best bid, and it helps make sure that the renovations are done. We all participate in the asset management, right? We have 2 calls a week per property where we get on with the property manager, we review occupancy, We review our strategy, because you have to be careful. What people don't realize is, the first thing we do is we force down occupancy. So, if you buy an apartment complex, like, the intention is to renovate the units, and you can't renovate them if people are living there. So we either don't renew the leases, you know what I mean, or somehow get the occupancy lower while we're doing the renovations. So, but you have to manage that, right? Because the lenders want you to maintain a certain occupancy level to make sure you can keep paying your mortgage. Your investors want you to hurry up and get a higher occupancy level so you can start giving them cash flow payments.
Yeah. We're running short on time. Tell us a little bit about your opinion before we wrap up about where you think the market is going, right? So you got this acquisition team, you got your operations in place. Are you excited or are you worried? And what pivots are your team making to kind of roll with the ebbs and flows?
So let me preface by saying I have no idea.
Okay.
I want to say that in case I'm wrong. But so it's so funny. I interviewed this. For any of y'all who listen to Bigger Pockets or read their books and stuff, there's this guy, Jay Scott. He wrote the book on
Rehabs.
on flipping houses, the book on estimating rehab costs, recession-proof real estate investing. I interviewed him back during COVID, and he had a bunch of predictions. And he knows more about economics and how they pertain to real estate than anybody I know. But he made a bunch of predictions in the middle of COVID, and he was wrong about all of them. So I had him back on the show. I interviewed him yesterday, and we were joking about that. And he was like, well, I'll try again, because economics is a soft science, right? We generally understand how certain levers affect certain things, but sometimes, like, they change the rules of the game, you know what I mean? And the government can change the rules of the game. You never expect certain things. But I'm not terribly worried because of the now, the broader economy. I can't imagine all this money printing and inflation is good, and you'll probably see some wonky stuff going on in the stock market and with unemployment. But for the housing market, we are incredibly behind as a nation and locally. We have a housing shortage. So we're like 2 to 5 million housing units short. And people can't build fast enough because of a few things. We have supply chain issues, we have labor shortages, and now we have higher interest rates. Well, people don't understand, like, to build the homes, you got to borrow the money. And you're gonna borrow less money and build less homes if it costs more to borrow the money. So that prohibits inventory from coming on. So, I mean, housing is a supply and demand. So the raising interest rates slow the transactions. Like, I'm very much in the camp that you're not going to see this big housing crash. I mean, you're not going to see like a 2008. But that being said, I'll tell you that my flips are not as selling as fast as they were 3 months ago. I mean, 3 months ago, I was getting 5 offers day one. Now they're sitting for a couple weeks, making me sweat a little bit. You know what I mean? So it's slowed a little bit, but I think it's still there. Transaction volume. I mean, days on market in Baton Rouge, where I'm operating, is still 6. Like it's still a seller's market. Anything less than 30 is a seller's market. It's just not that insane seller's market that we had gotten spoiled by. Yeah. Interest rates are still manageable. They're just not those insane rock bottom rates that we were spoiled by. People forget, like, the last couple years is not the norm. We're just getting back to the norm.
Yeah, Steve, you can start coming up for needs and wants. One of my final questions before we take questions from the audience, Sterling. So what does 2022, Sterling, what advice does he give the 2018 Sterling with the wrinkled suit and the tired shoes? And I know why you wear flip-flops now, because you had the shoes on at the airport. Now you wear flip-flops to the closing.
I wear flip-flops to the closing. I wear cowboy boots to the properties because they got snakes and rats and roaches. And I don't like them crawling on my toes.
Right. So what do you tell that guy now, the 2022?
Man, I don't know that I'd tell him anything because it was a lot of work. And if I told him how much work it was going to be, he might not have done it. You know what I mean? I'm glad I did, you know what I mean?
Yeah, well, we're going to get ready for audience questions. We'll take your hands.
I got a question. Hey, bro, so you go through the BRRRR method for single family and apartment syndication. What are you doing with the rising interest rates? Because you're betting on being able to refi in both sectors, right?
Yeah.
How are you viewing that and safeguarding against that? And is there
So in the single family space, I'm flipping more houses, and in the apartment syndication space, I'm buying rate caps.
What's a rate cap, for those who don't know?
It's an insurance policy that you buy with the lender to basically, regardless of how high the interest rates actually go, you won't go above a certain point.
Next question.
Came into apartments, when you go buy apartment complex, do you figure out the price per the building and divide it up into the doors? You have a certain amount you want to pay for each apartment door, or you look at it just when you buy it?
Yes. So, yeah, it very much depends on the market, right? So, in in Charlotte, North Carolina, I would pay $180 a door, where in Baton Rouge, Louisiana, I'd pay $60. So, and it just also depends on the class, right? I would pay a lot more per door for a Class A 21 build than I would for a Class C 63 build.
All right, well, Sterling, man, we definitely thank you for your time. How can people get in touch with you, and how do we find that Rent Roll Radio?
Man, I think you can find it everywhere. I wish you would. I wish everybody would go on and like and subscribe to my podcast, The Rent Roll Radio Show, wherever you get your podcast. I think most people get them on Apple. I'd also like The Rent Roll Radio Show. I'd also like you to go subscribe to my YouTube channel. I'm on YouTube, TikTok, Instagram, Sterling Chapman. DM me or you text me at 225-247-5562 or email me, sterling@crestworthcapital.com. If you're interested in the apartments, you can go to our website, crestworthcapital.com. I wrote a 14-page ebook you can download for free. Yeah.
All right, last question. So this group is about helping people close the gap from where they are versus where they want to be. So how can we help you close that gap? What you looking for the most right now?
I don't know.
Apartments or cash?
I mean, right? Probably capital.
Capital, okay.
Yeah.
Gotcha. All right, man, everybody put your hands together for Sterling. Thank you again for your time.